Hey there traders, and welcome back for episode 92 from the stockbandit.tv, where you find trading videos to make you better. I'm really glad that you're here. All right, so for the past few episodes, numbers 88, 89, and 91, we've been discussing stop losses, and we've covered a ton of ground. And we've talked about the time frame being traded. We've talked about the personality of the stock and how that has an impact on where stops ought to be placed. We talked about the chart of the stock and the importance of that when you're trying to determine an exit. And in the last episode, number 91, we talked about the impact on position size that a stop loss ought to have. And so I've said this before, but please, if you've missed those, go back and watch each one of those. If you don't, you're going to be in trouble, and I'm going to find out about it. All right? Now, for those of you who have seen them, you have permission to proceed. So in this episode, I want to take this topic and make one final point on this topic of stop loss placement, and it's going to be a little bit different than the first few episodes of this series. And up until now, we've been discussing initial stop loss placement, and that is the most important safety net to string up at the outset of a trade. But in this clip, I want to talk about stop loss management as that trade progresses and matures. As our stock makes its move and we see that original stop loss get farther and farther away, it's natural to need to alter where it lies, especially if you're like me and you continually evaluate what's being put at risk. Originally, it was the potential for loss, but hopefully later in the trade, you're staring at open profits and you're starting to consider how to retain those profits, and those are certainly important to protect. So let's just take a look at a quick example. Here is ADS, and this is a play that we took in the member area over at the stockbandit.com just 4 days ago on a breakout from this small consolidation area. This stock jumped out of this consolidation to the upside, and it's run quickly higher, and we were able to close part of our position on the way up, and now at this point, whereas my original stop was set down here, now my target for this trade is only about right there. So I'm very close to my final target here, and I'm a long way from where my original stop would have been. So at this point in the trade, it makes much more sense to tighten my stop and bring it up much closer so that I don't give back all of this ground here if the stock would happen to reverse, okay? So adjusting a stop to a higher level if we're trading on the long side often takes on the name of a trailing stop. And most people, when they think of this phrase, think of that choice in your trading platform called a trailing stop, and that would be the automatic route whereby you designate a set amount of money per share or a percentage, which if the stock happens to decline by that amount from its highest level since you entered the order, then it's going to trigger a sell order of some kind. Again, the type of order it's going to generate is of your choosing. But for example, you could set a 2% trailing stop, and if at any time your stock gives back 2% off its best level, let's say it's moving like this and it pulls back, well, if from this peak to the lowest pullback area is 2%, then it's going to generate a sell order right there and get you out of this trade, okay? So that's how a stop loss works, and a trailing stop would work that way if you set it, for example, on a 2% basis. But again, it's going to be up to you, and that's how an automatic stop loss or trailing stop is going to work. And while these automatic trailing stops really are a great idea, it really is difficult to decide how far away to set them. So for example, a trailer that's set too loose to your trade might mean you're giving back substantial open profits if it's reached. Let's say on this particular play, I've caught a very nice move to this point, but let's say I give it a 15% trailing stop. Well, that would be somewhere way down here, and I'm not willing to do that. So that's too far for me. And again, this is going to be based on your time frame. But on the other hand, a trailer that's set too tight might mean it's going to choke off a good trade and not allow it enough freedom to move in a natural way, and thereby it may cause a premature exit, and it might cost you some opportunity. My personal preference when it comes to trailing my stops is to do it manually, and this enables me to stay dynamic with my stop, keeping it moving as I should, but it also lets me evaluate the trade on a regular basis in order to determine where that stop should be. If the stock being traded is really lively, or if the overall market is getting highly volatile, then I'm prone to keeping my stop a little bit wider, and I'm maybe going to give it a little bit more room. But If we're in a quiet trading environment where the stock is starting to show a little bit of fatigue or maybe even some narrow range days, then I can probably keep my stop a little bit tighter, okay? Let me make a couple more points here when it comes to trailing a stop, no matter if you choose to be automatic or manual about it. First, be consistent. I can't stress this enough. Put some rules in place for whatever works for you, and then implement those rules on a consistent basis. So for example, maybe you say after a gain of X percent, let's say it's 10%, okay? Maybe after you get up 10%, then you're going to reduce your risk by a certain amount. So maybe one way that you can do that is something that I do, which is for most of my swing trades, I'll set a couple of profit targets on the upside. And once my first target is reached, I like to go ahead and tighten my stop for remaining shares to at least break even. And I think that's essentially going to give me a free trade. And that's just one example, but put some rules in place for money management for you, which are sensible for your trade and the time frame you're operating on, and that are also in keeping with your personality. And then once you've got those, stick with them. I know it'll help you when you need to tighten your stop loss on those trades. Second, consider your reward to risk ratio throughout your trade. A trade that starts out with a structure that will give you 3 times the profit than you would lose if it failed ought to maintain some resemblance to that throughout the trade. But what you don't want is at your ultimate profit target, once you're starting to see that light at the end of the tunnel and you're almost about to exit a position, you don't want to have a stop that's way down here a mile away, okay? At that point, you're going to be risking far more than you stand to gain, and that's certainly just not good. So always think about risk and reward and the relative distance of your stop versus your target compared to where price currently stands. And when it makes mathematical sense to alter your stop, do it. All right, so now I hope you've really enjoyed this stop loss series and you've picked up some good stuff to apply to your trading. Thanks again for joining me for this episode, and I will be back soon with more videos, but in the meantime, trade like a bandit.